that is sensible as traders understanding what leverage is. I can already see somebody here has said thank you for clearing that up for us. If anybody did not understand what leverage is, feel free to ask the question through the GoToWebinar software, or this is my email address here, and I will go through it once more. So issues with trading. So this is what we're going to be looking at today. So normally when I speak to traders, as a trader which is having issues with trading, it's normally for one of two reasons. Normally it's because they're entering too early in the market, or they're entering too late. So what is the issues with entering too early in the market? When you're entering too early, before the movement actually happens, the issue is that you're spending most of the time in a loss. Now, for new traders, this is going to be very harsh for them emotionally, because it means they have to be patient and they have to wait for the trade to go on a profit. You may incur higher fees if you're going to keep it open overnight. You may be required to keep the trade open longer. So again, you may incur higher fees. You must keep your cool for longer, because of course you have to be patient, wait for it to go to a profit. And you may be required to close the trade before the market moves in your favor. So you may be required to close your trade in a loss, so in a minus, because you entered in too early and you had to close it because the market was moving against you and you don't want to incur large losses. And then, of course, after that, the market would have moved into your favor. But the issue was that you entered too early. The other issue is entering too late. So, to be honest, it's pretty much the same as the first. The issues are similar. So, if you enter too late, you may only spend a very small amount of time in profits, and then it goes into a loss. You may lose out on most of the profit. You may be required to keep the trade open for longer. This is another reason as well. You may miss the movement completely. So if you're looking for a trend and you see a trend, but you're entering too late, you may miss that movement. So again, it could result in you missing out on that trend. In which case, again, you'll be having a trade with a loss. Now, another issue which a lot of traders tend to have is they keep trades open for too long. So bear in mind, the longer you are keeping the trade open, the higher the risk is. So if you are looking to trade, open the trade, set a target, make sure that target is something realistic. It's not something large or unrealistic, or something where the risk is extremely high. And then you can keep hold of that, keep hold of the target, and once it hits the target, to automatically close it. Don't try and keep it open and earn more and more and more. And this is, I want to kind of get involved into this slide within regards to not being pressured into trading. You should definitely not be pressured into trading, ladies and gentlemen. Now, me as a trader, because I've been trading for a very long time, there's always going to be somebody who's going to look to give you some idea within regards to trading, give you a hint, give you their opinion within regards to how the markets may move. But do not ever be pressured into trading, because believe me, there's always going to be a friend, a family member, someone when you're speaking to them over dinner, is going to give you a hint to buy this stock, to trade this, to trade not one stock, but to trade 20 or 30 or 50 or 100 stocks, large amounts. You should never be pressured into trading. So have a trading plan so you know what it is that you are trading. Make sure you're not trading too many assets, because it's going to be very hard for you to keep up. Have your stop loss, have your take profit. If you want to use these two tools that we have available for you, make sure you stick to your plan, use your analysis, and do not be pressured into trading. Never enter a trade unless you personally have done your analysis and you personally believe that the trade is the right trade and going to profit. So moving on. Now, this is a great slide. We had it a couple of weeks ago. I wanted to go through it one more time for the new traders because I still am getting a lot of emails in regards to what traders should be trading. Because I do get a lot of emails every single day. You know, Michalis, I'm not sure what asset to trade. Which do you believe is the best asset for me to trade? Number one, don't try and get financial advice from us, from your account manager or myself, because we cannot give you financial advice. And to tell you what asset to trade is classified as financial advice. But what I can do is I can tell you the characteristics and the pros and the cons of each asset. Now, which one is you wish to personally trade is completely up to you. So the first one, and actually our most traded asset, is stocks. Stocks tend to have lower leverage, but they tend to have higher volatilities. So the volatility of stocks sometimes can be higher. However, the leverage is much lower, much lower. Normally, the leverage on stocks can be something from 1 to 5, 1 to 10, 1 to 15. So because of that, the volatility is very low. You're not going to see your price and your investment move as fast with stocks unless you're trading them at a very highly exposed level. And the good thing about stocks is it's something that everybody can relate to. And most of the information is something understandable because it's something to do with companies and the stock market, which is much more understandable than something very difficult like indices, commodities, and cryptocurrencies. So a lot of new traders tend to go to trading stocks because there's less volatility, it's something relatable, companies which you know as traders. The good thing about stocks is they have very clear trends, they've got very clear retracements compared to, for example, other assets which are unpredictable. Information on stocks is easily accessible. Just go to Google, type in Amazon stocks or Alphabet stocks or Adidas, then click on news, and you will get hundreds and hundreds of articles with analysis, with news, and things that you can take into consideration within regards to traded stocks. And if you go to our YouTube page and type in Essential, there is webinars which are specifically related to trading stocks. Now, Forex, which is currency pairs. Currency pairs has less volatility than stocks. You will very rarely see a currency which drops by 50% in value. Very rarely, unless you trade them, for example, currency pairs which are very unstable and have very poor sentiment behind them, like, for example, the Turkish lira, which is very poor. Other than exotic currencies like that, you're not going to get so much volatility. However, you can deem to have a high leverage on currency pairs. So on currency pairs, you can have a high leverage like 1 to 100, 400, 300, 200, 1 to 50. These are high leverages. So you can have high leverages with currencies. However, of course, that is completely down to you whether you want to be trading so high in terms of currencies. Then, with regards to the information, it's like stocks. There's a lot of information within regards to currency pairs. So again, that's something very helpful because that information you can use as part of your analysis. And you personally, as a trader, it is something you can keep in mind. Then, within regards to commodities, the commodities have a lot of volatility regardless of the leverage. They've got a lot of volatility and they are known to be very unpredictable. However, because they've got a lot of volatility, there is bigger movements in the market. So people that are looking for bigger movements, because of course everybody is a different type of trader. There is traders that want big movements in the market. Those traders, of course, have the option to trade the commodities which have big movements and big jumps and crashes in the market. That is an option for traders as well. And the same thing goes to cryptocurrencies. Cryptocurrencies, I'd say, is the most unpredicted, the most volatile. The only difference between the two is commodities is not so volatile, not so unpredictable, even though it still is. The difference is that there's not much information available on cryptocurrencies, whereas on commodities, there's a lot of information, which is a big pro within regards to commodities. So moving on, now this is really going to help you within regards to the timing of your trades, number one, and also to make sure that you are never overexposed. You do not want to be overexposed, ladies and gentlemen. Now, when you see a movement and you see a movement like this, and traders tend to get sucked into this type of trades, when there's a trend and you enter here because there's a trend, you want to make money from the trend. Here you're trading BMW CFD stocks, you're trading 10 stocks. This is my required margin, so that is the amount I require to open the stock. Now, before you open the stock, and before you choose to open 10 stocks, that is the volume of the trade, you should think to yourself, let's look at 3 worst case scenarios to make sure that if something bad does happen in the market and the market moves against me, that I'm not going to be overexposed. I'm not risking more capital than I actually want to risk. What you should do is work off 3 worst case scenarios. Now, a lot of people are going to say to me, I don't know what scenarios to look at. A lot of people look at the 3 swing lows. So this here, so you can see there's a wave, also known as a swing. Now the swing lows, a lot of people use these as the worst case scenarios. So you've got one there, you have one here as well, you have one here as well. Now, of course, it's down to you what scenario you want to work off. Could drop to there, could drop to here, could drop to here. Now, if you click on set a buy, because here we're buying, and then you click on stop loss, what you can do is you can put these figures in. So for example, you can put, if the stock drops to $60, this is what I'll be losing. If it drops to $55, this is what I'll lose. If it drops to $50, this is what I'll lose. Now, if all 3 scenarios is something you are comfortable with, then great. You are not over risking or overexposing yourself compared to your risk appetite. However, if you put these figures in to the stop loss, and you can see below, it will actually tell you what is the figure in terms of actual money. If these 3 scenarios is too high, it could be you're going to make a loss of 5,000, 10,000, 15,000, high figures like that. Then you can just lower the amount of stocks you're buying. You can buy 1 stock instead of buying 10. If the figures are uncomfortable, you're losing 50, 100, 150, and that is something you are comfortable with, then by all means, you are, of course, in line with your risk appetite and your risk profile and can proceed with that type of specific trade. So if you follow that as a trader, it is definitely something that is going to help you massively. It's going to help you to make sure you're not overexposed in the market, and that you are keeping to your personal risk appetite. Because of course, everybody has a different risk appetite. Some people are risk averse and they don't want high risk. Some people are not. Some people want high risk in order to try and achieve much larger profits. But of course, everybody is different. And this is why we must use this technique, look at the 3 worst case scenarios and check here on the stop loss here, what each movement would mean in actual figures of dollars, what it would mean. Because of course, if it drops to $60, $50, or $55, you don't know what that figure means unless you put it on the stop loss like I've done here. Now, something else which is going to help you within regards to the timing of your trades and trades in general to make sure you're trading in the right direction of the market is spreading the risk between different indicators. Now, a lot of people do not use indicators, in which case, especially if you're a new trader and you're trying to phase out some of the background noise and you want indicators to assist you with your trading, then you can use indicators. However, indicators are not 100%. So try and use 2, 3, 4 indicators in order to get the right information. For you to get 3, 4 signals in the right direction instead of just one signal. Of course, if you're getting conflicting signals, if you've got false indicators on your chart, make sure that all 4 are signaling the same movement, the movement in the right direction. Because of course, if 2 are pointing that the price is going to go up and 2 are pointing it's going to go down, then that may not be such a strong signal for you to trade on. Now, issues with timing. Now, a lot of issues that people have, like I said at the beginning, some people see a trend like this, and because they're looking at this big movement over here, they want to enter here, which case a lot of time is the end of the trend, and the movement starts to go down after that. Another reason people may see trades that are in a minus is because they're trying to trade in the opposite direction, and they could trade, let's say, for example, here, and they trade in a buy, so they want the price to go up. But the price does this before actually going up like that, in which case they entered too early, because of course by the time it hits down here, you may already close the trade because the market is moving against you. You may not want to move in that direction. Now, something which is going to help you, price action, something very basic. We keep looking at it over and over again. But something that can be very helpful is what is known as Elliott wave or Wolf wave theories. There's lots of different wave theories, but all of them are based on swing highs and swing lows. So, of course, trends always, for it to be an official trend, according to Elliott wave theory, will look something like this. You will have swing highs, and each swing high is higher than the other. So you can see each tip on each occasion is higher. Each low is also higher. Can you see that? Each low is also higher. So as the price goes down and then moves back up, you can see still a trend because the high is higher and the low is higher. This is for an upward trend. And you've got, of course, downward trends as well, which is the exact opposite. You need each swing high and each swing low to be lower. So like this. So these are the swing low. And you can see on each occasion the lower. Can you see? Like so. Now, a lot of people mistake movements like this that I'm going to draw now to be, for example, an upward trend. They get something like this. To be an upward trend because it's overall going up, but this overall chart is not an upward trend. Why? Because you can see on occasions you get lower lows. So you can see here you have lower lows, then we get high highs, but then we get lower lows again, and then okay, we start to get high highs again. But you can see it's mixed. It's not one overall trend. So bear in mind, you have to have higher highs and higher lows in order for there to be a trend. So when you are trading, you see a movement like this, be aware there's going to be a pullback. there will be a pullback at some level. At some level, it's going to at least do that. What you can do is you can draw the significant level, which is this. And as it passes it here, it's at that point that you can look to trade an uptrend, because you know it's gone to a new high. This is based on wave theory. Now, if it drops below this level, then okay, we may be looking at a downward trend. If it continues to drop below the previous low, then we're definitely looking at a downward trend. But as long as it doesn't, if it starts to drop like this, for example, we draw another swing high here. As it drops, goes back up, then we know it's a continuation of the trend. Then as it starts to drop again, we draw a line here, and so on and so forth. And this is to trade the trend, to make sure, if we could, of course, could have been entering down here, but we're still analyzing that the trend is continuing until we get a lower low like this. So you can see it dropped the low, we had a low which was lower, and then it crossed to a lower low again. So again, this is going to massively help you. Now that is something you can do with indicators. Now this is an example. You can see here that I'm not using one indicator. I'm using moving averages, which is the green and the also orange line. And then I'm using a stochastic oscillator. Both are there to assist me with trends. So it's not there to assist me with overbought or oversold. It's more there to assist me with trend movement. Now, with regards to trend movement, if we look at this type of indicators, what we are looking for is for there to be crossovers. Now, I'll explain to you exactly what crossovers are referring to. This here is a crossover. So you can see it crosses over upwards. Now, at the same time, you can see on the stochastic oscillator, it's also crossed over upwards. So this is what I'm saying, referring to more than one indicator. I'm looking at two indicators and making sure they're crossing over in the right direction. Look, it moves all the way up to here because I've used two indicators. Then this indication here is the next one. This next circle crosses over downwards. On here, it crosses over downwards as well. And look, it drops all the way down to here. Of course, sometimes we don't get the greatest indicators. So for example, here it crossed over up and it crossed over up here. To be honest, it did go slightly up. It went up to there. So if you are a short-term trader or an intraday trader, that's more than enough movement for you. But at the same time, it didn't last very long. It only lasted about 8 hours. But to be honest with you, for 90% of traders, that movement is more than enough. But even if it wasn't, and the market moves against you, you just simply close at the next crossover, trade it to drop down. And it's the same type of scenario here. And you can see what I can do is I can switch between different time frames. So I've got first a 4-hour time frame, and then before entering, I check again on the 30-minute time frame to make sure I'm getting the same indication. So you can see I'm referring back and forth between two indicators and at the same time between two time frames. That will massively assist you with your timing. So overall, to recap, number one, have different scenarios. So if, for example, you're trading in the wrong direction and you enter the buy here, check if it drops to here, what would I be losing? If it drops to here, what would I lose? If it drops to here, what would I lose? And make sure each figure here is not something which is going to damage your account. That's number one. Number two, you've got the wave theories to massively assist you. In which case, if you're trading downwards, you've got one significant price in there, two significant pricing, three significant pricing here. And you can see how on each occasion I'm trading the downward movements. Yeah. And last but not least, refer between 2-3 indicators, and also between 2 or even 3 time frames as well. Now that's brought us to the end of today's webinar. Hopefully that was useful information for everybody. I hope you trade safely, trade responsibly. If you have questions, please let me know. In the meantime, trade safe. Have a lovely day and a lovely weekend. And hopefully we'll see you very soon on one of our webinars. Thank you very much and have a good afternoon.